Hello, it's very good to be back with you again. I'm Nicholas Bohnsack, President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. Last week we spent some time discussing inflation, and it would seem, at least for the moment, that inflation is generally in check. Roughly 9 million folks who had jobs a year ago today are either out of work entirely or prevented from going to work due to various restrictions related to the virus. So in the labor market alone, there would appear significant slack. Similarly, a fair amount of equipment remains out of service, suggesting sufficient capacity exists in the manufacturing economy, and that will need to be taken in as demand and output recover before inflation rears its head. It's worth noting there are also secular trends that have helped to keep inflation low over the last several decades. Confidence in the central banks, the decline of unions and the price of labor, globalization, technology, competition, even the tax code. Now, at the same time, there are signs that inflation may give a scare this year. The unleash of consumer demand, a function of the vaccine and stimulus, and of course the base effect of anniversarying the lockdown itself. Thus, it appears inflation is Krylov's elephant. It's difficult to ignore. It's also difficult to ignore the recent backup in interest rates. U.S. 10-year yields began the year below 1% at just 92 basis points, and today are almost 130. In a world awash in liquidity and nearly $16 trillion of negative yielding sovereign debt, there seems something incongruent about the U.S. 10-year yielding just 1.3%. Particularly with the potential, quite likely in our view, that the nominal GDP could break above 8% this year. Higher rates, of course, make equity market participants nervous. But this strikes at the importance of keeping a regular dialogue with your Baird advisor. The market can correct at any point, of course, which is why we have a plan, and it's focused on the long term. So before we get nervous about the backup in rates, consider stock prices and bond yields can and often do move higher simultaneously. This is a reflection of improving economic activity. The risk to financial assets, particularly equities, does not in our experience occur when interest rates move higher or at the first sign of inflation. No, equity prices wobble when the Fed indicates that it is ready and willing to break inflation. The resulting sharp increase in the overnight rate lowers collateral in the overnight market, which leads to deleveraging, and with it, lower equity prices. We're not there yet. Fed Chair Powell has indicated the central bank intends to view inflationary shocks as transitory this year, and that their proclivity remains to keep the Fed funds rate anchored toward the lower bound for the foreseeable future. Now, make no mistake, investors are keen to test the Fed's mettle on this point, and so we'll suffer some volatility because of it. Expect the 10-year U.S. government debt to continue to ratchet higher towards the end of this year. Where rates will top out, of course, we can't say. But on such uncertainty was built a wall of worry, and in that we are inclined to stay bullish. And while it's always important to work with your Baird financial advisor for the impact on your plan, we would consider bouts of consolidation as an opportunity to continue to rotate into cyclicals as part of a balanced asset allocation. There's a lot to consider here on the inflation front and on rates. But if you stay focused, follow the plan, you'll come out the other side just okay. Know the Baird team's here to help. Stay well. We'll see you again soon.